Most investors will never build serious wealth. Not because they lack access to markets. Not because they lack capital. Not because the system is rigged against them. Because they cannot maintain a consistent behavior for longer than 6 months. They save aggressively in January. They stop in March. They start again after reading something inspiring. They stop again when the market moves against them. The cycle repeats. The portfolio stagnates. The years pass. James Clear spent a decade studying why this happens. His answer is uncomfortable. The problem is not motivation. Motivation is abundant. It arrives every January and disappears by February. The problem is that motivation-dependent systems fail by design. And almost every financial system most people operate is motivation-dependent. Clear's framework does not ask you to be more motivated. It asks you to build a system so well designed that motivation becomes irrelevant. In his book Atomic Habits, Clear identifies the precise mechanisms that cause intelligent people to repeatedly act against their own financial interests. And more importantly, the systems that permanently close that gap. Clear's book is not a finance book. It is a behavioral framework for understanding why humans do what they do, and how that can be changed. The argument is precise. You do not rise to the level of your goals. You fall to the level of your systems. For the long-term investor, this distinction is everything. From the ideas in this book, we can derive 7 financial blueprints. Blueprint 1. The aggregation of marginal gains. In 2003, the British cycling team was one of the worst in the world. In over 100 years of competition, British cyclists had won a single Tour de France. Then, a coach named Dave Brailsford took over. His philosophy was simple: find every process involved in cycling, improve each one by 1%. Let those improvements compound. The team redesigned bike seats for comfort, optimized the sleep positions of each rider, changed how riders washed their hands to reduce illness. No single change was significant. Together, they were transformational. Within 5 years, British cyclists won the Tour de France. Within 10, they had won it 5 times. Clear calls this the aggregation of marginal gains. The structural insight for the investor is direct. A 1% improvement in savings rate is barely noticeable. A 1% reduction in fees is invisible in any single period. A 1% improvement in tax efficiency seems negligible. But aggregated across 30 years, these marginal improvements produce outcomes that dwarf any single investment decision. The lesson here is that wealth is not built by finding the perfect stock. It is built by improving every variable in the system, slightly, consistently, without stopping. Most investors spend their energy searching for the exceptional opportunity. The compounding investor improves the system itself. Blueprint 2. The Plateau of Latent Potential. When you begin investing consistently, nothing seems to happen for a long time. You save diligently for a year, your portfolio barely moves. You invest consistently for 3 years, the numbers feel underwhelming. You stay the course for 5 years, friends question your discipline. This is the plateau, and it is where most investors quit. What they do not see is what is happening beneath the surface. Clear uses the metaphor of ice melting. You lower the temperature of a room degree by degree, nothing happens. The ice does not melt. Then it crosses 0, and everything changes at once. The ice was not failing to respond for all those degrees. It was accumulating the conditions for transformation. This is identical to how compound growth actually works. The first decade of disciplined investing produces results that feel disproportionately small relative to the effort invested. The second decade accelerates. The third produces outcomes that seem almost impossible. Until you understand what was happening on the plateau, the investor who abandons a system because it produces no visible results in the short term does not understand compounding. They are quitting at degree -1. Stay on the plateau. The transformation is already in progress. Blueprint 3. Systems over goals. Every investor has goals. Clear's central argument is that goals are largely irrelevant to outcomes. This sounds wrong. It is correct. Consider 2 investors. The first sets a goal to save $50,000 in a year. She has no system. She saves when she remembers, invests when she feels confident, checks her portfolio when the market moves. The second sets no specific goal. He has a system, 10% transferred automatically on the day income arrives, allocated by a fixed rule, reviewed once per quarter. After 5 years, the second investor has accumulated significantly more, not because his goal was better, because his system removed the requirement for repeated decision-making. Clear identifies the critical flaw in goal-oriented thinking. Goals create a binary outcome. You either achieve them or you do not. And if you achieve them, the motivation that drove you disappears. The saver who reaches their target number often stops because the goal was the finish line, not the behavior. Systems do not have a finish line. They are continuous. They do not end when a milestone is reached. They simply run, and in running, they compound. There is a second problem with goals that Clear identifies. Goals focus on outcomes that are largely outside your control. The market determines your returns. Your employer determines your bonus. The economy determines your opportunities. What is inside your control is the system, the saving rate, the allocation discipline, the decision not to sell during a correction, the commitment to review and rebalance on a fixed schedule. Define your system first, then execute it without deviation. The goal will take care of itself. Blueprint 4: Identity-Based Investing. Most investors think about what they want to achieve. Clear argues the more powerful question is who you want to become. He distinguishes between 2 layers of change. Outcome-based change. I want to save more money. Identity-based change. I am someone who saves before spending. The distinction is not semantic. It determines how durable the behavior is under pressure. Outcome-based habits are fragile. They depend on motivation and willpower, both of which fluctuate with circumstance, energy, and emotion. Identity-based habits are structural. Every action consistent with the identity reinforces it. Every action that contradicts it creates friction, a small but real resistance that makes the wrong behavior harder over time. An investor trying to avoid impulsive trades is fighting an impulse every time. An investor who identifies as a long-term, disciplined capital allocator does not experience the same impulse in the same way. The identity has already made the decision. Clear calls this the concept of voting for your identity. Every action is a vote for the type of person you are becoming. Every time you transfer savings on the first of the month, you cast a vote for that identity. Every time you hold through a market correction without selling, you cast another. Every time you ignore short-term noise and stay the course, you reinforce who you are. Votes accumulate. Over years, they become the investor you have built through repetition. This has a direct implication for periods of market stress. The investor who has spent 5 years acting as a long-term capital allocator does not panic in a correction. Not because they are fearless, but because selling everything contradicts who they understand themselves to be. Identity is the most durable form of financial discipline. Do not ask what a good investment looks like. Ask what a rational, long-term investor would do in this situation. Then do that. Blueprint 5: The 4 Laws of Behavior Change. This is the structural core of Clear's framework. He identifies 4 laws that govern whether a habit forms or fails. Make it obvious. Make it attractive. Make it easy. Make it satisfying. Each law has a precise application to financial behavior. Make it obvious. The investor who never sees their savings account never thinks about saving. What is invisible does not generate behavior. Automate transfers so that capital moves before you can spend it. Make the investment account the first line on your financial dashboard, not the last. What is prominent becomes habitual. Make it attractive. The brain is wired to pursue immediate reward and avoid delayed gratification. Investing is the opposite. You sacrifice now for benefit decades away. Clear's solution is to pair the act with something immediately rewarding. Link your monthly contribution review to a ritual you enjoy. Reframe investing not as deprivation, but as the most direct expression of your long-term identity. Make it easy. Every additional step between intention and action reduces the probability that the action occurs. Pre-select your allocation. Set automatic rebalancing. Eliminate every decision point that requires repeated willpower. The investor who has to actively decide each month whether to contribute will contribute less consistently than the investor whose contribution requires no decision at all. Make it satisfying. This is the hardest law for the long-term investor to apply. The rewards of correct financial behavior arrive decades in the future, far too distant for the brain's reward system to reinforce the present behavior. The solution is to create immediate feedback loops. Track your savings rate monthly. Record every contribution. Build a simple dashboard that shows cumulative progress. Make the invisible visible. To break a bad financial habit, invert the 4 laws. Make it invisible. Remove trading apps from your phone. Disable real-time portfolio notifications. What you cannot see easily, you will not act on impulsively. Blueprint 6. Environment Design. Willpower is an unreliable tool. It fluctuates with energy and stress. It depletes under pressure. It fails at exactly the moments it is needed most. The rational alternative is not to develop stronger willpower. It is to design an environment where correct behavior requires no willpower at all. Most investors rely on discipline to save, waiting until month end, assessing what remains, transferring what they can. This is a willpower-dependent system. It fails predictably under financial stress, during lifestyle inflation, in periods of market anxiety. The environment-designed alternative removes the decision entirely. Savings automated, transfers on the day income arrives, allocations predetermined. The only remaining decision is whether to interfere with the system, and interference requires active effort. Clear's principle is that the best financial behavior is the one that requires the least ongoing decision-making. Wealth is not built through superior intelligence or market insight. It is built through the deliberate removal of the conditions that cause intelligent people to make poor financial decisions. Design the environment, then trust the system.
Blueprint 7.
Never miss twice. Clear introduces a rule that is simple in concept and difficult in practice. Never miss twice. He is not arguing for perfection. Perfection is not the standard of a durable system. Consistency is. The investor who misses a monthly contribution once has not failed. Life creates interruptions. Markets create anxiety. Circumstances change. The failure is not the first miss, it is the second. Because the second miss signals that the behavior is negotiable. And once a behavior is negotiable, it is no longer a system. It is an intention. One missed contribution does not destroy a portfolio, but missing twice creates a new default, a lowered standard that becomes progressively easier to accept. When life interrupts the system, and it will, the only priority is returning as quickly as possible. Not with guilt, not with compensation, simply with the next correct action. The investor who contributes every month for 30 years, except for 3 months during a family emergency, has not failed. They have demonstrated exactly what a durable financial system looks like. Imperfect, consistent, unbroken in its direction. Never miss twice. Now let's step back and look at the full picture. 7 blueprints, 1 underlying principle. Behavior, not intelligence, determines financial outcomes. Marginal gains compound over decades. The plateau rewards those who stay the course. Systems outperform goals because they remove repeated decision-making. Identity shapes behavior more reliably than motivation. The 4 laws of behavior change apply to every financial habit. Environment design replaces willpower with structure. And never missing twice is the only consistency standard that matters. The investor who applies these principles does not need to predict markets or find the perfect asset. They need a system and the discipline to protect it. Build the system, run the system, never miss twice. And that is your financial blueprint. If you found this analysis valuable, leave a like and comment. It helps the video reach more people who care about long-term financial thinking. And subscribe to the Finance Blueprint for more structured breakdowns of the world's most important financial ideas.